Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today we're diving into a report that might sound as exciting as watching paint dry, but trust me, there are hidden stories in these numbers. We're going to look at a shareholder report for the Coho Relative Value Equity Fund, and 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 the Coho Relative Value ESG Fund, examining how they performed and what they invested in during the last 6 months. Let's find out if these funds are making smart moves or just moving money around. These funds are part of something called the Managed Portfolio Series, and this report covers their performance from August 1, 2024 to January 31, 2025. Essentially, it's a checkup to see how well they managed their investments during that time. The report includes information about the fund's costs, key statistics, and what the fund invested in. It also provides information on how you can get more details about the fund. Let's cut to the chase. How much did it cost to invest in these funds? The report gives us the cost based on a hypothetical $10,000 investment. For the advisor class of both funds, the cost was $40. What this means is that for every $10,000 you had invested, $40 went towards expenses. Expressed as a percentage, that's 0 cents a percentage, that's 0.79%. That's important because it eats into your returns. It is important to note here that both funds are charging the same costs. Now, let's look at some key stats for the Coho Relative Value Equity Fund. As of January 31, 2025, the fund had net assets, which is what they own, minus what they owe, of about 99 million billion. That is how much money they are playing with. They had 20 non-funds investments during the year. This could point towards a fund with a more active style, although it is fairly low. The Coho Relative Value ESG Fund had about $37 million in net assets as of January 31, 2025, with 25 holdings. Its portfolio turnover rate was 15%. Again, this low turnover rate suggests a more buy and hold investment strategy. Where did these funds put their money? For the Coho Relative Value Equity Fund, their top holding was United Health Group, making up 5.3% of their total investments. Other top holdings included Cencora, Ross Stores, and Thermo Fisher Scientific. Those top 10 holdings make up around 40% of the value of the whole fund, which would be a good level of diversification. The Coho Relative Value ESG Fund's top holding was also United Health Group at 5.2%. Other significant investments included Ross Stores, Lowe's Companies, and Cencora. The equity fund had heavy allocations to healthcare, consumer staples, and consumer discretionary sectors. ESG fund also had heavy allocations to healthcare, consumer staples, and consumer discretionary sectors. These funds are very similar in allocations. Moving on to the financial statements, let's check if the money is flowing as expected. I'll skip right to the part that everyone looks at, the statement of operations, which shows the fund's income and expenses. For the Coho Relative Value Equity Fund, the net investment income was approximately $222 million. However, when you factor in realized and unrealized losses on investments, the fund saw a net decrease in net assets of about $893,000. The Coho Relative Value ESG Fund, on the other hand, had a net investment income of about $253,000. And after accounting for realized and unrealized losses, there was a net increase in net assets of about $51,000. This is not a large profit, but it is a profit. Taking a closer look at the equity fund, we can see the net assets at the beginning of the period were about $418 million and ended at $100. The ESG fund started with about $47.5 million and ended at about $37.4 million. The ratio of expenses to average net assets after waivers is about 0.79% for both funds. This tells us how much of the fund's assets are used to cover expenses. It is very important to check this number. All right, wrapping up our little exploration into these two Coho funds, let's zoom out and see what this all means. The numbers show both funds are facing a challenging environment, with the equity fund experiencing a net asset decrease. Both funds share similar expenses. The investment choices lean towards healthcare and consumer staples, indicating a defensive strategy perhaps. So what's the verdict? There are no real red flags here. The funds are in line with their stated goals. As always, do your own homework and see if these funds fit your personal investment goals. If you found this dive into the world of financial reports helpful, give us a thumbs up, drop a comment, and subscribe for more decoder action. Until next time, keep your eyes on those numbers, and remember, there's always a story behind the spreadsheets.